Hi, Tyler. Welcome to my podcast. Thank you for taking out time and coming on us.
Harshit, thank you for having me. When you asked me to be part of this, it was a no-brainer. I'm so pumped to be joining you and to be speaking about real estate investing as a whole. It's one of my passions, and I'm so excited to just hear the questions and to have this organic conversation with you. Thank you.
That's amazing. So, Tyler, before we start, do you mind giving a little bit introduction about yourself so that a new audience can know more about you?
Yeah, I wear a lot of hats within the multiple organizations that I work with, but it all kind of bottles down to a portfolio manager. I run our portfolio management division here at REC Canada. It's a great, fancy, title, and it's a good, to feel good in the heart to see that title. But essentially, what that is, Harshit, my job is to sit down with investors, understand who they currently are, ask the right questions to understand their challenges, their successes, their dream outcome. And from there, my organization is able to then show them some opportunities. And then, afterwards, we go and find those specific opportunities to invest in.
That's amazing, man.
Yeah.
Amazing. So, Tyler, now you know that market has shifted. Now, what do you think? What are the strategies these days investors are taking, or what you are guiding your investors to take strategies?
Yeah, and it really depends, right, Harshit, in regards to strategies for a specific investor. And I know we're going to be speaking about a little bit later building that term that we'd like to say a laddering plan, which is a
Right.
way to essentially time your investments chronologically.
Right.
But the strategies I'm finding investors needing to go into with the current state of the market is one, a desire for cash flow. So they're exploring secondary, tertiary markets, ones that have had a little bit of turbulence on price point. So we're seeing a little bit of a price drop. Rents have increased over the last year and a half, even though they're stabilizing a bit now.
Mm-hmm.
And even with higher interest rates, cash flow opportunities are presenting themselves. And I think the satisfying the cash flow bucket is, especially with the current state of the market and the turbulence we're going through, it's something that a lot of investors are prioritizing in their portfolio.
Right.
The the other, I would say, main need that I'm noticing investors having to satisfy in their portfolio is to eliminate some of the costs associated with higher interest rates or expenses. So what they're doing is they're strategizing and investing some of their liquid capital into more passive opportunities like REIT style investments, private lending opportunities, something that's giving them monthly cash dividends so that it can offset some of their liquidity issues right now, to say the least. And
Right.
then, just general other strategies I'm hearing investors wanting to, explore are, you know, those conversion types of opportunities. And I know that's one that you have some experience in, which
Right.
is, taking a single family home, a fixer-upper house, finishing the basement, adding units to the property, which will then drive cash flow. As well, you get active appreciation, Harshi. You get the change in value. And I would say those three are the majority of opportunities that we're speaking to investors about. But it's as you know, real estate investing is not a one size fits all plan.
Of
It
course.
does take some strategic planning and just understanding what they want, because my plan and your plan, Hershey, could be totally different from one another, but we're still ending up in the right direction, which is building wealth or generating wealth.
Absolutely. And so you are seeing that more and more investors are now moving to duplex, triplex, kind of a investment just for the cash flow in the tertiary markets.
And taking advantage, I would say, of the lack of buyers currently, and that's shifting actually even today. But these types of homes, let's give an example. We just had an investor of ours. He bought a single family home, 6 bedrooms in Welland. This is just tied up actually yesterday,
Right.
and he bought that for, I'm not going to give the exact number, but let's say around 515,000. That
Right.
exact same home at the top of the market was selling closer to 680.
Right.
So, he's taking the people are taking advantage of the lack of buyer's presence, so you can actually negotiate some deals, which is a breath of fresh air when we're representing buyers.
Right.
As well, though, with the lowering of purchase price, you're able to maximize your cash flow.
Okay. And what we both have worked for in the pre-con world a lot, but what is your experience currently? What you are seeing in the pre-construction industry at the moment? Are there
Yeah.
still any opportunities or
There
what's
are
happening?
there are a tremendous amount of opportunities right now.
Right.
What I've noticed, and you got a pretty good hand in that side of the sector as well, Harshit. So I'm gonna ask you a few questions from your experience as well. But I
Yeah.
would say right now, with the pre-construction sector, the only opportunities I'm seeing are ones that have already launched last year, the year before. There
Right.
are opportunities that developers, in most cases, have already started the pre-construction sale. They haven't reached that limit to start construction yet, so they
Right.
need these units sold. And that's where the opportunities in that sector are presenting themselves. The ones that are giving cashback incentives on closing, which will help eliminate some of that cash outlay that you need for that investment, which
Yeah.
at the end of the day is how I, in most cases, calculate your ROI is based off of the capital you put in. They're offering rental guarantees, but between you and I, and everyone listening, I would lean towards taking more of a cashback incentive compared to a rental guarantee. We have a historically low vacancy rate here in Southern Ontario. I don't see that changing, especially with what I'm about to say afterwards, after this statement or this insight. And then also, we're not seeing obviously a dramatic increase in price. In fact, we've seen prices, kind of flatline.
Right.
And it's a misconception. And I'm not sure if you're hearing this from some of your investors that you're speaking with, but a lot of, some of my insiders that I've had conversations with about new build investments, excuse me, they were thinking that prices would go down. But the reality is that, it just got that much more expensive to build this high-rise development.
Yeah.
They have these municipal charges that get added on top, some of which, are up to $200,000 a unit, depending on the municipality, as well with labor increasing, materials increasing, potential changes in certain governments in U.S. and Canada side. It's going to just make things more expensive, and this type of this type of development, the developers have their margins, so you're not going to see much of a reduction in price. But what you can get instead are some of these incentives, and they're really good. Like these, some of these cashback incentives I've never seen before. How high they are. Like one of these projects I saw was like almost $30,000 cashback. 5% down until like 2025 or something. So, you can get extended deposits, cashback incentives. Don't go to the rental guarantee. Personally, it could affect your HST rebate in some cases. As well, though, like you can just rent it out. I take cashback all day over that. But yeah, that's what I'm noticing in regards to the opportunities. In regards to the investor's mindset, we've obviously seen a shift in investors, kind of what they deem as that investment they need in their portfolio. You see, when it's all a mindset and what that herd mentality is seeing. When we saw these massive growths of appreciation, investors, because they were priced out of the resale, single family homes, duplexes, triplexes, they naturally put their money into the pre-construction opportunities because that was what they could get into, and they didn't have to put all their capital down at once. Now, what the mindset has shifted now is because there's an ability to actually go and negotiate on the resale side, we're seeing less investors take a look at pre-construction, but that's when we should start exploring it, in my opinion. But we have to look at the fundamentals, and to me, we gauge on the pre-construction side three fundamental pillars, let's call it, that will qualify that specific opportunity. First is location. You can't pick up the building and move it somewhere else. Location is critical in all of your real estate investments, but with pre-construction, because you're not getting cash flow in that investment, you're really just trying to invest based off of the appreciation of value, situating yourself in a long-term hold type of approach. Location is very important. And if you actually want to zoom in a little bit, Harshit, on the location metrics, you want to look at first and foremost the potential for population growth. How early are you in this revitalization of this location? The earlier that you get in, from experience, not even opinion, from experience, the better, the best position you would be in. You want to, it's very easy to actually also gauge this, other than just looking at these high rise, constructions that are actually being launched. What else you can actually see is, if you just drive around, see where commercial complexes are about to be built, see where subdivisions potentially are going to be built, see where these, the signs in front of these properties are permitting.
Zoning.
Who's going to speak to the city about adding units to these properties? The earlier, the better, and that's just a good way to gauge. The second part of that location metric is transit. You want to be as close to transit as possible, and try to, if you can, Harshit, get into this, this new, as early as possible to a wave of development for transit. Values will always follow transit. Once an area becomes more accessible, the population will follow. And then lastly, with location, you want to find, in pre-construction specifically, you want to find a location that has a diverse employment sector. You don't want to invest into a municipality that is only anchored on one main industry. The reason being is that you go through harsher cyclical appreciation, depreciation cycles, especially when that main industry, like for example, if we looked at Oshawa 15 years ago,
Right.
we would say, with the GM plant being stationed there in its main industry, main employment sector, every single time the GM plant, Harshit, would go and go up, their leases up, or their employees were striking, wherever that is. If you took a look at Oshawa at that time, 15 years ago,
Right.
they had a very harsh cyclical pattern. The values went down. You want as stable as possible in the employment sector, and the best way to have stability is have diversity. So find a diverse sector. So first is, again, that was location. Second is developer. You want to invest in a pre-construction opportunity with a developer that has a proven track record,
Absolutely. Yeah.
as well has opportunities that are currently under construction. You see a lot of developers that built great buildings in the early 2000s, but they haven't done it in 20 years. And not that they would build a bad building potentially. It's just a different game now. It's a different industry. You want a developer that is in tune with the current state of development. And then that last metric is incentives. Pricing is first, obviously,
Right.
but some of these other incentives, the extended deposit structures, cashback incentives, capped closing costs or development charges, discounts on parking, whatever your criteria is, just try to find one that fits the best. And don't be afraid in today's market, for all investors out there, to actually negotiate. Just try to put something on paper and see what the developer says.
Right. Yeah. At least now developers are ready to negotiate. That's the best part. Otherwise,
100%.
we wouldn't have got an opportunity to even ask for that.
Mm-hmm.
The project used to launch and everything used to just sell in the weeks.
100%.
Yeah. And Tyler, now I've seen some of your videos where you educate clients about 4 ways to win in real estate, right? Can you elaborate on that a little bit?
Sure. Yeah. So the 4 ways the 4 ways to win in real estate, essentially, Harshit, what that is the 4 categories that break down your ROI on active real estate investments. Those 4 ways to win is, first, cash flow, gross rent minus all of your expenses. What do you get out of that property net, monthly or yearly? It could be cash flow negative, neutral, or positive. The second one is passive appreciation. Passive appreciation is the metric, which is how much value does your property increase based off of the location that it's in. So that is very area specific in regards to, or area and asset type specific in regards to the growth there. That's the value growth without you doing any work to the property. The other side of that coin is active appreciation or forced appreciation, some call it. What that is, Harshit, is how does the value of your property change based off of the work that you do to the property? So, that could be you renovating a basement, for example. Renovating a basement, you put $100,000 in, but you know that homes in that specific location with the finished basement sells for $300,000 more than what your home is currently worth. And that's what active appreciation is. And then lastly is principal paydown. Principal paydown, as you're making a mortgage payment, you're paying interest and principal. Interest, we're not going to be able to do anything about. That's the price to play the game. So we're just going to shelf that for a second. But every time your tenants pay you rent and then you use that to pay your mortgage, you're lowering down the balance on your mortgage. That gives you the ability to leverage this equity in a few ways, either by selling or Harshit by doing these creative financing options. So the 4 ways to win for all the listeners here that breaks down your active real estate investments again are cash flow, passive appreciation, active appreciation, and the last one is principal paydown.
Right. So Tyler, now if an investor or if a person wants to invest, let's say in a duplex, right? So they buy a bungalow and they want to add a unit in the basement. They want to legalize the basement and let's say spend $80,000 to $100,000, right? So how they can evaluate what kind of appreciation they should expect by converting into a duplex, like a legal duplex?
Well, first I would say, work with investor savvy realtors. One like Harshit right here. For everyone listening, you got to reach out to Harshit, and he can help you a little bit with this fine combing of breaking down investments. But on the real, what you would do is you would take a look at comparable sold data on homes in that location or that micro market, maybe like within a kilometer to a kilometer and a half radius if it's in a major metropolitan area, and just try to see based off of the comparable properties, what does a home with the finished basement sell for? And then you kind of have to zoom it in a little bit more. What do homes with finished basements with accessory units sell for? And what do homes with finished basements without the accessory units sell for? And then from there, there's a little bit more that goes into it. But from there, you can at least evaluate, is this the right move for me? And you first have to take a look at overall cost. I always say costs go first. How much will it actually approximately cost for you to finish this basement? If they're legalizing it into an income suite, what's the cost of getting the permits, hiring engineers or architects to actually go and design it for you? What's the cost of labor, materials, all of that? Get that first. Add a contingency fund, call it a few extra grands. Hope, I don't know what because you kind of went through a similar process. Like, what was your contingency fund? Did you add like 10,000 to the top? Like, what'd you add?
Obviously, I was doing like multiple projects, so I had to have some kind of like cash reserves and lines of credit access to capital.
Yeah.
Definitely in construction, I would say 10% to 20%, you can easily go up and down.
There you go. So you're gonna add at least 10% of whatever you expect it to be on the top to add to it, because delays happen. And you know what I find, and I'm going off on a tangent right now, Harshit.
Yeah, that's fine.
I find that investors who purchase those types of opportunities for conversions, they don't calculate carrying costs in it as well. And I think that's really like it's such a simple thing to me to think about. You're going to have to hold the property and pay a mortgage or a loan while you're doing the work to the property. And in most cases, you can't rent it out while the work is being done. So there's a carrying cost aspect.
At least for 6 to 12 months.
Yeah, or they don't budget enough time. And the last thing that you would ever want in this type of investment is to be, cash poor. Like that's why I would I like to gauge or I like to put specific asset opportunities in categories. And I always say, like, if you're doing a conversion, I think that's high risk in regards to, like, it's high risk, high potential of high reward. But for me, it's a higher risk because of the cash outlay and the potential for variances on the cash that you would have to outlay. But it's at least a medium risk. I would put it at a high risk.
Right. So, like, Tyler, in your experience, what you have seen, because you have dealt with so many investors for, let's say, duplex conversion, right? Maybe in Welland or St. Catharines area or
Yeah.
any area. So, what type of a deal have you seen? Like, they bought the detached for 550, they put in, let's say, 100 to 150, their cost is 700,000. What is the ARV that is coming out to be
Yeah.
roughly?
Yeah. So you know what? In most cases, what I find, unless you're doing the work yourself, I
Hmm.
actually find in most cases, Harshit, you're probably just going to be making, that growth of value, you know, back based off the capital you put in. I didn't phrase that properly. So you're going based off of the money that you put in. Let's say you put in, $150,000 to finish a basement. Okay.
Right.
Usually I only see the value going up by like 150,000 to 200,000. Like you're not going to see in most cases, a huge swing of value increase
Okay.
unless you do the work yourself. And that's why, like, out of all the types of investments, flipping is like the lowest of low for me
Of
in
course.
regards to,
Too risky.
actual to actually go and do it's one, we already spoke about the risks,
Right.
but if you have a delay of like 3 months, that will actually break your investment. Like your margins are so tight there if you're not doing the work yourself. And in most cases, and I can go through examples, like real life examples, but you're really just making the money back that you put in. You're able to maybe do some sort of refinance after you rent out those units, just to get the capital that you put in back. Satisfy some of those lines of credits that you used.
So Tyler, like most of the investors these days on the active side, they are buying these detached, converting to duplex, or maybe adding an ADU. So what is the like main motivation behind those investments?
Yeah, so for everyone that doesn't know, ADU, it's an auxiliary dwelling unit. Essentially, it's a garden suite. It's a standalone structure that you're adding to your property. And there's a huge wave of interest from investors and homeowners right now to add those units to their properties. And I think it kind of goes into a few different reasons for it. There's never just one reason. Um, one reason that I have spoken to a lot of homeowners about is with their homes potentially being a little bit more unaffordable based off of their current situation, their employment situation. They want to find ways to at least offset some of these expenses that they're currently having to pay. An ADU specific edition might be right depending on the lot permissions in the area in the city, but it is one that I'm seeing a lot of homeowners at least explore because they have a lot of equity like built into their property. They don't really want to go and use the equity to buy an income property or invest it into stocks. They just want to have something where it can generate some income for them. Another reason is because of the shift of generational homes, multi-generational homes. You're having the grandparents, yourself, your kids, potentially even some other family members, aunts and uncles live in the same property. Space is obviously needed, and that's another good way to add some space to it. It increases the value of your home as well in most cases. So, it's kind of you take out of one pocket, put in the other type of situation for some. Another reason though is as we're seeing prices increase, Harshit, and this year, like Urbanation report just came out for 2024. The only one we haven't seen is December yet, but the only asset type that has increased in value year over year is freehold properties. Those
Right.
single family homes, those detached, semi-detached homes. And the reason why I think investors now are focusing on these opportunities is they want to get into the market, with the rising cost of entry, they're realistically for the foreseeable future only going to be getting into one or two properties, and which is great, by the way. I'm not saying only like it's, no, like it's the worst thing that can happen. That's a privilege that we should all be celebrating. But
Right.
the 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 reality is though, as we're seeing prices increase, we're seeing a reduction of cash flow. We're seeing, a tremendous amount of hardship to actually get into these opportunities. And once we reach a certain price point, I believe we're not going to see big swings of growth. We're just going to see very stable 2% increases, 1% decreases. And I think that number's around like 1.8 million of an average price point, maybe 2 million. And what investors are trying to do now is they're at least trying to get ahead of this. They're trying to buy, something where they can actually change the fundamental asset class of that specific opportunity. So convert a duplex into a triplex or a fourplex. They're adding units and changing the asset class of that opportunity. So they're getting some forced appreciation in value.
Right.
They're now valued higher. So the passive appreciation percentage is more in regards to the dollar amount of growth. As well, as we get up to that price point, that was one of the only investments that really makes sense, is the ones where you can change the fundamental asset class. And yeah, that's another reason why. And then the third reason is the cost. The cost to add those units have gone down. We're seeing some fantastic prefab, already constructed in a factory homes that people are just adding to the back, and it's creating inefficiency. It's creating lack of it's creating a faster job, which helps with everything that we said in regards to flipping previously. But yeah, it is something I speak to a lot of investors about, but that's not right for most, honestly.
Right. And I've also seen in like Toronto area, people are building like 4 units on the main detached property
Yeah.
and a laneway suite. And that could be like a good cash flow.
Yeah, and I think that one of the reasons why our provincial government is really in Ontario is really trying to make this heard and spoken about
Right.
is and they're going through like zoning changes every single day. It's changing, and it's not even where it needs to be, but excuse me, but at least they're being proactive with the Harshit, is because as we're seeing, because what I said before is we're not seeing many like high-rise developments start.
Yeah.
And right now, we have a record number of supply hitting the market. But the reality is by 2030, 2031, we will see a reduction of units hit the market because development it hasn't started today.
Right.
Like these are ripple effects that are going to be affecting our market way past 2030. And what I think the provincial government, as well as just municipal governments, are doing is they're trying to at least offset the lack of high-rise construction and units hitting the market with at least the missing middle, which is adding density to these single-family homes and these detached lots.
That's right. And I've seen like a lot of cities now offering $80,000, up to $80,000 to add those units as an ADU, right?
Yeah, 100%. And it's just not all municipalities are right. There's obviously like a price analysis that you have to go through. But it's a good option, especially if you want to focus on cash flow and you
Yeah.
have some capital that you can actually go and deploy. I think it's something that is a potentially good option. I think exit on that, and I think time will tell, but I do believe that with those types of opportunities, you're probably going to have to actually extend your exit point. You can't exit after 2 years. Like you're gonna have to hold it for 5 years to 10 years to make that investment work. Because in
Yeah.
most cases, as I said before, you're probably just going to get the money back that you put in.
Right.
To it.
Plus you invested your time too, right?
Yeah, yeah, exactly. 6 months, a year.
Yeah. That's good. Another thing, Tyler, what we wanted to discuss today with you, because you're an expert in this field, is the concept of property laddering.
Sure.
In order to grow your or build a portfolio, you need to plan your properties, right?
Yeah, that's right. So laddering your investment is a term I use almost every day, Harshit, when I speak to investors.
Right.
It's a sexy term, but essentially what it is strategically planning your investments maturity dates on your mortgage, as well as the exit points of the investment. And there's a strategic reasons why we do that. And the main reason is if we can strategically plan exit points of investments as well as maturity dates on your mortgages, it
Mhm.
hedges against, the turbulence of life. It hedges against, employment shifts or changes, life changes, health changes. Not everything comes in at the same time, and that might be at a bad time for you. Think about having 3 mortgages coming up for renewal, at a time where you just lost your job, right? You might have a liquidity issue or a approval issue now.
Right.
The second thing is that it does hedge against market turbulence and interest rate turbulence. If someone has planned their portfolio properly, these interest rates, challenges that we went through from 2022 to now, they might have had renewals at different points of this. And that will help your averages in regards to your interest rates and your overall payments, your expenses. And then also just to strategically planning your 5-year to 10-year plan, with the end goal in mind. It also helps, I think, visualize for that investor how to actually do it. How do you scale it to whatever that goal is? And all of that is done from laddering plans. And do you want me to talk about how to potentially do it?
Yeah, just a quick brief about it.
Yeah, so first I think what investors need to understand is who they are, truly. No, like who I want to be, like that's afterwards. Right now, we need to understand snapshot, where do you lie in regards to investing? How much capital do you have available? What do you like with investing? What are some of the challenges that you've been through? Where's your ability to get financing? Who are you going to be working with in regards to joint venture partners or investor partners? These are really important metrics to understand to build that investor profile.
Right.
Only then, when we understand capital available, ability to get financing, and risk tolerance, let's call it those 3 main things, then we can talk about goals of investing. Where do they want their portfolio to be in 5 years, 10 years? How do they want their, how will their life change based off of the investments that they do grow and they do acquire? As well, where does your job change at that point? And how does employment change? And those are really important. Once we get a good idea of investor profile, then
Right.
I draw a line. Can I do a whiteboard? It's easier to explain this way.
Yeah.
Let's see if I could do a whiteboard. So I do it this way, and I excuse my chicken scratch because I feel like I should have been a doctor in another life because my writing is awful. But okay, so let's say, Harshit, we're doing a line, okay? We're doing a line here. Can you see this?
No, we cannot see this.
You can't see the whiteboard?
Yeah, now we can see. Yeah.
Okay, so that's year 1, and call this year 5, okay?
Right.
Okay, and let's say we have investor profile. Can we do a text box? So investor profile, okay?
Mm-hmm.
So let's say they have capital 150,000, okay?
Right.
They have the ability to secure financing. They have a nice stable job. They don't have too much debt. They haven't invested in real estate in the past, let's call it, other than their primary residence. And then their long-term goals is to own 5 doors in 5 years.
Right.
That's a very common one. Own X amount of doors in X amount of years. I hear that all the time. And then I even bottle it down for everyone who's listening. If you have a goal of 10 doors in 10 years, what does that mean, wealth generated ones? What does that actually mean? How much is per unit, in the 10 years, how much is that worth to you? Well, let's just say, and you have to have that number, right? The wealth generated. Let's just say the wealth generated here is, I don't know, $1 million. No, that's, $1 million of equity, let's say, okay?
Right.
And can you hear me okay? Because I just have one of our concierge calling inside. Okay, so we have our investor profile, okay? They're okay with risk. They want to invest into active real estate opportunities. Now, let's say year 1, right here, we're going to start with an income property, okay?
Like a duplex or a detached townhouse.
Exactly, duplex, triplex. Let's just do a duplex, for example, because of the 150. So we're going to have a price point of 600,000, for example. We're investing in Niagara Falls. And for 3 years, we're not doing too much with this opportunity. We're renting it out. We're getting a little bit of cash flow. We're allowing the properties to appreciate.
Right.
Right? So we're just going to let the equity build here. Okay. And now we're at year 3. All of this under this line is equity growth. Okay. Equity growth as well as cash flow, let's call it. Now, let's say by year 3, the values have appreciated enough where we can take out $100,000 of equity. Okay.
Right.
3 years.
Payment, right?
Yeah, including, regardless, like based off of the current state of the market at the time, it appreciated 7% per year for 3 years. We have, the 80% loan to value. We have $100,000 that we can pull. Okay.
Right.
So we're gonna pull $100,000 out of here. Okay. So now our income properties at this point,
Next January.
right?
Mhm.
And then what we've done with that $100,000 at year 3 is we've also bought or invested into a REIT opportunity. REITs, okay? That's a real estate investment trust. Essentially, what a REIT investment is, it's a passive opportunity. You don't have to get a mortgage for it. You don't have to manage tenants or manage properties, manage toilets. What you need to do, or what the REIT investment is, it's essentially you're investing into a portion of a holding company that already has investment opportunities or income properties, multiplexes, commercial opportunities within this holding company, and your growth is based off of the value of that specific holding company as well as the cash flow that it generates. So, so this is the REIT. We invest $100,000 in here at that point, okay? And that's why it's important to have a good maturity date. So let's say year 3 is when you plan for your maturity to
Mortgage.
Your mortgage maturity is here. So then we're going to refinance it. And look, so we've taken out, oh, I gotta switch the color. We've taken out some of the equity obviously here, but okay, now we're starting here and letting it grow again, right? At the same time, with this REIT opportunity, we're allowing this to grow as well. And the only thing that we would like to calculate is, this is usually a 5-year hold. So this brings us now to year 7 there. And then we're just finding strategic times to leverage growth. And maybe at this point, maybe year 7 with this income property, then we can think about taking out some of the equity because it's been 5 years since you've leveraged this to go buy another income property or a pre-construction opportunity. And that's essentially how you build a laddering plan, very simply and fast.
Right.
I hope that visual aspect helped me explain it a little bit better.
Of course, visual aspect is always better, right? To understand. And that's very helpful. I really appreciate that.
Yeah, it's just essentially what the laddering plan is just a way to strategically plan when to leverage growth, when to exit opportunities, and really try to avoid things coming together at the same time.
Right. Another thing I want to add to it, that the investor should be okay to take up that new mortgage that they are taking, right? Because every refinancing, they're putting on more debt.
Correct.
Be comfortable with that concept, that's it.
Well, I think you're so right there. You hit the nail on the head, Harshi, because what I think investors could have done better when we were in that massive expansion part, over the last decade, we looked at carrying costs. And, that's fair. We did look at overall, can I afford this property monthly? I have a little bit of money saved up. We looked at that correctly. But what I think was a metric that a lot of investors did miss, and it's a learning lesson now, hindsight's 2020, is the amount of debt that they're assuming. That's a very important number when you're trying to make these decisions on these large purchases. Sometimes even if the numbers look great, cash flow wise or potential for passive appreciation wise, if that debt number is too high or not right based off of your long-term investment plan, then it's not the right opportunity. We have to look at the amount of debt that we're assuming. And that also includes when is the right time to refinance or pull equity out.
Of course, yeah, that makes sense. Oh, that was a lot of wealth of knowledge from Tyler, right?
I've been going down a rabbit hole lately, especially as we're gearing the end of the year, Harshit. And right now, what I'm really trying to focus on is presenting options for investors,
Right.
building laddering plans with them based off of their risk tolerance. And I know we didn't really talk too much about the the types of assets. Do you want me to go over a little bit about what
Yeah,
are the
sure.
different active and passive types of opportunities?
Yeah, absolutely.
Okay, so there are two main categories of real estate investing, Harshit. There's passive real estate opportunities and active real estate opportunities. Why don't we
Right.
talk about passive real estate opportunities first? So passive real estate opportunities are investments where you don't have to get a mortgage for, as I said recently. Passive opportunities are ones where you don't have to get a mortgage for. There are ones where you are just investing that initial capital and that
Right.
capital is growing. Those main three passive investment opportunities are one, REIT style investments that we just
Yeah.
spoke about, private lending, and land development. And don't confuse, for everyone listening, land development to pre-construction opportunities. They're part of developing, but they're different parts of this process. What land development is that you're investing your capital with a financing company or a developer, and they're going to be using that capital to help start the marketing process of the building, help the pre-construction sales, all the way up to completing that specific high-rise development. Think of it as a portion of your construction financing.
Right.
And the land development, there's things to consider with all, but with these three specifically are exit points on the opportunity. And specifically with land development and private lending, usually your funds are tied there until either the maturity date on that private lending opportunity, or on the land development side, your funds are tied there until whatever it is your funding is completed. So understanding the risk and the time is very important. But they're all compound, in most cases, compound growth on the initial on the capital that you invest. So those are passive.
Right.
Active investments, the other main category, these are opportunities where you're going to have to get a mortgage for in most cases, manage tenants, manage toilets. They're more hands-on of that investments. Now the advantages there, and they all have like individual strengths and things to consider, but the main advantage there is that you can actually capitalize on the four ways to win that we spoke about prior to in all of these active opportunities. That's passive appreciation, cash flow, active appreciation, and principal paydown. And with that in mind, there's main categories within active investments. And the first one is your traditional residential investments, those single family homes, duplexes, triplexes, resale condos, resale townhouses. After that is pre-construction opportunities. That's you buying from the builder. Um,
Mhm.
you don't have to get a mortgage until the completion of the project. You're paying off those incremental deposits, and there's advantages there. The third one would be those rehab types of opportunities, those conversions, those fixer uppers. Your exit points there could be like you're flipping it or you're holding it long term until that value has reached a threshold that you're okay with exiting. And then after that, you get into more of the I would say more advanced in active investments, multifamily, commercial, and the last one is land development. Like not land development like you're helping finance a high rise, like you're actually doing some sort of build yourself.
Subdivision and building.
Yeah, exactly.
Right.
And those are active and passive investments,
Right.
and they all have
Their own.
strategies. They all have advantages, things to consider. Um, exit points are different in all of them, and depending on the way that you want to grow your portfolio, I think there's three main kind of speeds for growth. There's a conservative one, which is probably more of a low risk type of
Right.
approach. There's a growth focused approach, which is that middle of the pack. Types you're going to either low risk or medium risk types of opportunities, and then the last one would be like an aggressive growth. These are ones where you're putting a lot of capital up front to try to maximize active appreciation. And I would say in these cases, in the aggressive approach, that you're trying to really get some cash flow there.
Right. Before we end this podcast, Tyler, I just want to ask, what is, in your opinion, where do you think the real estate market is going to be in 2025?
That's a really good question. That's something I think about a lot. And no one does have a crystal ball.
Of course.
I personally believe, we're going to see interest rates change again. They will go lower. I'm not sure how much. Like yesterday, for example, today's December 19th. So yesterday, the Fed on the US side, they only lowered it by 0.25.
Yeah.
So that's why I never play the game of how much I think it's going to change value-wise, but I do think it's going to go down interest rate-wise. I believe that the freehold sector is going to be back to multiple offer situation. It's back to having to have these bidding wars. We're going to see maybe about a 5% year-over-year growth, maybe 6% year-over-year growth there. And what I think will happen naturally is we're going to start to see a division of asset types. We're going to see freehold stretch this way because there's a limited amount of supply as well. It's one that a lot of people traditionally do want to get into. And we're going to see, frenzy buying on this point as interest rates lower as well. But there's only a certain amount of point where the condos, the townhomes, the pre-construction condos can be so far apart. There's a lot of tension. And there will be a point where when this becomes unaffordable again, undesirable because people kept losing out, at that point, then it gets snapped. This will get snapped this way. And I don't think that will happen in 2025 personally, but I do think that's going to happen, closer to the 2026, 2027 time.
Absolutely. That is spot on what I think.
Yeah, there you go.
And thank you, Tyler, for your time. I really appreciate you doing this brother with me. And I hope our audience might have gained some value from it.
I really appreciate it, man. Harshit, I'm always available to speak. I know I used a little bit of a whiteboard there. I did some drawings. I'm always available if you want to have another conversation, because truly, like, just having these types of insightful conversations between you and I are ways that will help me grow, help me present options and opportunities and ideas to the investor that I speak with. And, we're always growing, right? And I would say for anyone who is listening to Harshit's podcast right now, and you want some work to do, as we're leaning towards the holidays and December 2024 right now, try to have a budget, for the new year. Try to have a really strict budget with the focus of using some of the savings to actually actively invest. If you have the ability to invest into real estate right now, there's some good opportunities. There's always good opportunities. And there's always bad opportunities as well. But even if you don't have that much saved, like even less than 5,000, just have it work for you. Take a look at some of these stocks, these ETFs, S&P 500, for example, index funds. At least have some of your money being worked for you. And then, once you build your budget and your investment allocation, then really sit down with yourself, your partner, whoever you invest with and want to, surround yourself with in your life. Try to figure out where you want your life to be in 10 years or 5 years. Once you know your end goal and your why is strong enough, you will be able to find those solutions to get you there. You just have to ask yourself enough questions to get that strong why. Once you have that, you will be able to then get there.
Right. Well, thank you, Tyler, for that. I will talk to you soon.
Thanks, Harshit. I appreciate you.
Take care. Bye.